Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Adrian Day. He's been with me a couple, 3-4 times at least in the past, but for the sake of those of you who may not be familiar with Adrian, let me give you just a little bit of his background. He is considered a pioneer in promoting the benefits of global investing in the United States, and he's an honors graduate at the London School of Economics. He is widely recognized for his global investment commentaries and published research. He does publish a letter called Adrian Day's Global Analyst, and he publishes that, and I think it's available to investors or people that might want to pay the price, the subscription price. We'll ask him about that in a minute. He does also manage money under Adrian Day Asset Management, and I've known Adrian and have had the pleasure of being on several panel discussions with him in the past, and he is always very witty and also has a lot of great insights to pass along. So thank you for joining me again, Adrian. It's really a pleasure to have you with me.
Well, thank you, Jay, very much.
Let's talk a little bit before we get started. People can go to your website. I suppose the best place to go to is adrianday.com?
Correct, yeah. And then if they're interested in the newsletter, they click on newsletter. If they're interested in money management, they click on money management. They're two different businesses, of course. Yeah,
and so if they do that, they can find out what the what the requirements are and what the cost of your subscription is and all that sort of thing.
Exactly. Yeah.
All righty. So let's talk a little bit about first the U.S. economy. You know, the mainstream media would have us believe that things aren't really all that great, but they're not really that bad. And then certainly with all of the brilliant minds, the PhDs from Princeton, Harvard, and Yale that run our country, that are basically sitting at the Federal Reserve, and all those hundreds of PhD economists there, that we're in good hands and things are really coming along quite well. How do you see things? Are we coming out of this funk? Or do we have a real good chance of restoring America to what it used to be, a thriving, booming economy?
Well, two different questions, if I may. On the first part, the economy is improving. There's no question about that. It's better now than it was 5 years ago. Mm-hmm. But as your cynicism implies, very, very marginally. And frankly, this, as we know, this recovery has been one of the slowest, and not only the slowest, but the longest on record. Here we are 5 years after the depth of a recession, and we still have high unemployment. And you mentioned the mainstream media, and so many of the headline numbers are misleading. When you look at employment, for example, and new jobs creation, just as an example, an economy besides the U.S. with the people coming into the job market, young people as well as, of course, immigrants. We need over 200,000 new jobs created every single month. Mm-hmm. So when we get all these hurrahs over 180,000, we're mm-hmm. not even creating enough jobs to keep the economy moving, and that's why mm-hmm. you have very low labor market participation. Now something like 12% of adult males between 25 and 55, who are your prime working market. 12% of those people are not even in the labor pool anymore, and that mm-hmm. excludes people in the army, people in school. These are just people who should be working but aren't. Yeah. Jay, we could go through every single statistic, but let me just give you one that really hits home, and that is just how uneven this recovery has been. In the spring, aggregate household wealth in the U.S. and aggregate household income in the U.S. rose above the 2007 peaks for each of those two measures. That's aggregate. But if you look at the median is still down significantly, and the median is much more important to me than the aggregate, because the median tells you how the normal person is doing.
Right.
If you dig down into the numbers, this is astonishing, and I'm going to say it slowly because, it's difficult to comprehend when you first say it. If you look at the difference in household wealth between 2007 and the end of last year, so, 6 years from the peak, you find that the bottom 50% in terms of wealth are actually down 44%.
Wow.
Their net household wealth for the bottom 50% is down by 44%.
Wow.
All of the gains in wealth and income, pretty much, most of the gains in wealth and income have been in the top 10%. And there's something wrong with that because, you and I have no problem with the rich getting richer. I think I can speak for you on that.
Yeah, that's not a problem as long as they're doing it justly.
So long as they're doing it justly, honestly, and not, with government handouts, which is what's happening. The poor, you want the poor to be getting richer as well, which they're not. Anyway, so, I'm very skeptical about this recovery in the U.S., and especially when you think that so much money has been created to try to, get the economy moving. I think any objective observer would have to say that that's been a failure.
Yeah, well, where are the objective observers, though, Adrian? Because I certainly don't hear them on the mainstream. I suppose the mainstream press is made up of people that are in that top 10% or top 1% or whatever, enough that they don't really feel the pain. But I hear what you're saying. As one who comes from the Rust Belt in Ohio, Canton, Ohio, my father was a machinist. I know, going back in that part of the country, it's closer to the financial centers where people seem to be doing better, and the economies are a bit more robust here in New York and down in your area there, not bad along the coast, San Francisco and places like that. But it really is a hollowing out of the middle class, and debt to me, Adrian, is the key. I'm looking at debt and some of the numbers of college students tremendously in debt. They come out of college, can't find jobs. They're living with their parents after 2 years after being out of college, can't find work. So it's that's what I'm seeing too. And so what you're saying basically is very much in line with what my belief is. What about inflation? John Williams trots out some numbers. I don't know if you'd be in agreement with them or not. It seems to me, Adrian, what they don't say anymore is what is the cost of living. That's not an expression you hear. You hear the CPI, inflation. I'd like to know, when I was a young guy, they used to say what it costs to keep a family of 4 alive. And it seems to me that part of the reason, I don't know if those numbers you quoted there are net of purchasing power. They're probably using the government's CPI numbers. And if you use John Williams' numbers, which are closer to 8-9% or so of cost of living, then he argues that we've never really things might have gotten a bit better, but we've never really come out of the recession. And the kind of numbers that you're talking about with the lower classes, the lower half of the income below the middle class, that we're seeing a real decline that would seem to be more in tune with what Williams is talking about.
Oh, absolutely. But I should point out, those numbers I quoted are from the Federal Reserve. They are the government's own numbers.
Sure.
So the reality could well be worse. And you add on things, as you mentioned, more young people living with their families, living at home. How do you quantify that? That's difficult to quantify.
Yeah.
But certainly that's a reduction in the standard of living when people are forced to live with their parents, rather than getting their own house. So, the situation is probably a lot worse than I mentioned. And no, I have the greatest respect for John Williams. His work is generally, very, very thorough.
Well, thank you. I'm glad to hear that because I'm of the same mind. I know he is not looked kindly on by a lot of people, but the mainstream for sure, for good reason, I guess. In any event, no thief likes the floodlights coming on in the middle of the night. So I suppose that's part of the answer to that. All right. So, Adrian, though, I think you would agree with me if I said that you are not as much of a doomsday guy as I am. You and I have Gene Epstein on this show quite often, are somewhat more hopeful, I think, and you're a bit more optimistic than I am, I think, generally speaking. So what are you doing, or where should we be focusing on putting our money these days?
Good question. Maybe I'm considered more of an optimist than you, although it's amusing you'd say that, because in most circles in which I travel, they always call me a pessimist.
Yes.
But I think it's probably because I look outside the country perhaps a little bit more than, most Americans. Mm-hmm. And, we're seeing some quite astonishing values in many parts of the world. I'm a value investor now.
Yes.
That doesn't mean you jump in right now with both feet. But Hong Kong is a good example. Now, Hong Kong I would not be buying today. I'd like to see how these protests pan out over the next, few days or weeks. That situation has the potential to get extremely nasty if any violence is undertaken by the police or the PLA in Hong Kong. That would be a disastrous situation. Or if those protests spread into southern China itself, that would be a disastrous situation. But I'm looking at Hong Kong, and I mean, some of the valuations there are just astonishing. Some of the property companies, now the property stocks have been hurt a lot over the last, several months, in fact, largely because of concern about a property crash in China. Now, if you've got a Hong Kong property company that has a lot of assets in China, or a lot of whose buyers of residential properties in Hong Kong are Chinese, then you're right to be concerned. But if you've got a Hong Kong company, which is a commercial property management company with no Chinese tenants and with none or very little business in China, then the sell-off in those stocks is just overdone. We're looking at a lot. I mean, I'll just mention two, if I may. CSI
Please,
Properties.
yes.
Now,
well, I'm sorry, what was it again, Adrian?
It's called CSI, like Crime Scene Investigation. CSI Properties. The number is, the symbol is 497 Hong Kong. It's a small company, but it's trading at only 40% of its book value. It's got double-digit returns. It's a good quality company with good assets, with extremely little exposure to China, and yet, as I say, it's sold off, with the rest of the market. Hong Kong exposure 1.1 billion, China exposure 57 million. So this is a Hong Kong company. Earnings are up, revenue is up. Excuse me. So I just think it's a very, very cheap company. Perhaps a better one for listeners would be a bigger company called New World Development. You've probably heard of it. That's one of the largest companies in Hong Kong. The symbol is number 17, so it's one of the first companies, listed on the Hong Kong Exchange. That yields almost 5%, trades at 6 times earnings, sells at under 50% of book value. Again, a very, very strong company, growing, tremendous land bank, so assets very, very strong. I think you need to look at Hong Kong and maybe start picking away, and if the situation gets worse, if the stocks come off more, add to it. So that's one area we like a lot.
Yeah, well, let me ask you, can those stocks be purchased in the U.S.?
Oh, I thought you were going to say that. I didn't think about it till afterwards. You can buy New World. New World has an ADR.
Okay.
The symbol is NBVLY. Okay. Nancy, David, Victor, Larry, Yellow. It's reasonably liquid. 72,000 shares on an $8 stock. Not, but reasonably liquid. It's nothing like Hong Kong, 41 million shares, but I generally, Jay, I think you know this, I've said it before, I've said it on your show. Generally speaking, unless a foreign company is listed in the U.S., that means it's listed on New York or listed on NASDAQ, I prefer to buy them in the local market.
Sure. No, that's right for those people who are set up to do that. Any other places around the world you're looking at that look cheap?
Well, we're looking at good asset plays in Europe. The decline in the euro, of course, helps a lot of the European companies, particularly if they're exporters. One we're buying is a Prada. Everybody's heard of Prada, of course.
Sure.
Prada actually is listed in Hong Kong, even though it's an Italian company. The symbol is 1913 Hong Kong. But, not as bargain basement. You don't expect fashion companies, like that high-end brands to be bargains. But the growth has been tremendous, big exposure to China, returns in the mid-20s, very little, return on equity, 22%, for example, very little debt. So good quality company and some growth. We're buying gold stocks as well, of course.
Yeah. Any in particular? I know you're very keen on the prospect generators. Are there some favorites there in that sector that you like?
Well,
Virginia Gold is one of yours?
Which one?
Virginia?
Yeah, Virginia is one of my favorites. That's a long-term holding. VGQ on Toronto, VGMNF in NASDAQ, trading a little under $13. Interestingly, that one has not come off at all over the last year, unlike most of the gold stocks. So I would not describe that as a bargain. I would describe that as a really good, solid company with very, very low risk. Mm-hmm. They've got a royalty on Goldcorp's Eleanor mine, which comes on stream by the end of this year. So they're going to start getting that royalty probably in the spring of next year. They'll start generating money from that royalty. So that's one I like a lot. Mm-hmm. And I also like the big royalty companies like Franco-Nevada, Royal Gold. Again, the royalties are a good way to play gold because of the low risk in that sector.
Mm-hmm. Do you follow Eurasian Minerals at all?
I do. I think Eurasian is, moved up a tad in the last few days. That's all relative, isn't it?
Yeah.
At 70 cents, 71 cents, Eurasian, I think, is just a steal. If you look at it on an asset basis, Eurasian is just extremely, extremely cheap. They've got some, very good assets around the world, some very good joint ventures. They've got a joint venture with Newmont in Haiti, which is kind of on hold at the moment because
you're getting their mining law
in Haiti is on hold. But that they're moving ahead with, and they'll start exploring that. They've got projects in Sweden, copper projects with joint ventures in Arizona. No, it's a very, very strong company.
Adrian, I was talking to the management of that company a couple of weeks ago, and they mentioned the Russian asset that's a huge copper gold porphyry system that is absolutely enormous, and apparently there's some possibility of the Chinese buying that out from them, and what the management told me was if they sell it, they will get more for the price of their share of that project than the market cap of the company. So I think
it's definitely worth more than the market share of the company.
Yeah.
At the moment, the only people interested in a large copper project in Russia are the Chinese.
Right.
But from what I gather, there's certainly some competition for it.
Yeah. Well, that's interesting. I certainly, my engineer's telling me we have less than 2 minutes left. I know the Hong Kong issue is something that I'm going to be talking to Dr. Peter Treadway about next week. He's a money manager in Hong Kong and New York, and he's written an article here, The Coming Destruction of Hong Kong. But I did talk to Peter earlier this morning. He's not as down on Hong Kong as that. More or less taking your attitude, let's wait and see. This thing could clear out and it might be minimal damage and some great opportunities. Anything else, Adrian, you'd like to add before we say goodbye today?
No, I think you've pretty much covered it all, Jay.
Well, I'm sure if we had more time, I could dig some more good ideas out of you.
Absolutely. I hope so. Hope you're good. Yeah. I think the main key is these are difficult times. You need to be looking for bargains. We all know, Baron Rothschild said, buy when blood's in the streets. We all know that that's the time to buy things. It's just not always easy. So I wouldn't go overboard. I wouldn't be aggressive, but I would certainly be buying the sectors, that I've discussed.
All right. Well, thank you very much, Adrian, for your time. I really appreciate it.